Nilesh Shah, Managing Director of Kotak AMC. Nilesh, fantastic to have you back. Thank you for joining us. Nilesh, there are two concerns which I think needs some attention, and we'll discuss them. Concern number one: why is crude at $70? And B, why are bond markets getting so nervous? So which one do you want to start with?
So let me first narrate, you know, circumstances which Indian economy and markets are facing. They are probably similar to you, Nikunj. You had a terrific event upstairs above you. A lot of people died, and your entire operation got disrupted. But to the viewers, it didn't make any difference. You conducted your business as if nothing had happened. The show must go on was the philosophy which you actually demonstrated. I think there is a message over here for Indian economy as well as Indian market. Yes, the circumstances have changed, scenario has become difficult, but if we can maneuver economy and market like you maneuver your television studio and channelized all the resources to ensure that show must go on, then our market and our economy can be as successful as your studio is right now. But subject to that, yes, I completely agree with you that 2017 was a betting pitch. 2018 is likely to be South African seaming bowling pitch. Crude has gone up. Partly it is driven by demand and supply mismatch as OPEC has cut production and continued to maintain lower production beyond 31st of March. Second, there are events happening in Saudi Arabia, Iran, which could potentially further curtail the supply, and that demand supply mismatch is resulting into oil prices shooting up. If earlier the expectation of oil was $40 to $60 a barrel, today oil is likely to range between $60 to $70 a barrel, and certainly that's negative for India from a current account deficit point of view. It is even more difficult considering the fact that Indian rupee have been appreciating based on flows, and it has kind of become overvalued. The second concern which you raised is also related to bond market, where we have seen that despite no policy rate hike, the 10-year yield has moved up by more than 100 basis points. I think there are a couple of factors which are playing out over here. A market is willing to take either the liquidity risk or the price risk. Between 2011 to 2016, the systematic liquidity remained negative. Courtesy demonetization liquidity became hugely surplus, and at that time bankers and other investors leapt onto government securities because other instruments were not available. Now that liquidity is getting drifted away, and there's no guarantee whether liquidity will be there or not. The market, which is not assured of liquidity, is not willing to take both the risk together, liquidity as well as the price. The second thing for the bond market is demand supply mismatch. There is a 50,000 crore excess borrowing program, and while RBI did cut one auction giving indication that they are not happy with the current yield, but they haven't communicated that in that many words, and you still have to complete that excess borrowing program of 93,000 crore. So demand supply mismatch, excess borrowing program, and lack of assurance on liquidity like it prevails in developed market, I think is making bond market nervous. And we have seen that while beginning and year end, the US 10-year yield has remained around 2.4%, our 10-year yield has moved up by almost 100 basis points. So clearly there is nervousness in the bond market which RBI has to address.
So Nilesh, morning firstly, and you're saying that irrespective of this near 100 bips move that we've seen since the month of August, which was the strongest argument in favor of expanded equity valuation start of the year, is something that the market is going to ignore and equity inflows would continue unabated. Is that right?
So as of today, equity market is assuming that if RBI is successful in achieving 4% inflation target, and which is why for last so many years they have maintained tight monetary policy and taken out liquidity, and they have achieved lower inflation on consumer price for last couple of years. We have moved from double-digit inflation to mid-single-digit inflation, in fact lower single-digit inflation, which is now threatening to go up a little bit to mid-single-digit inflation. So if RBI is able to anchor inflationary expectations around 4% target given to them, then the 10-year yield cannot sustain at 7.35 or 7.40. Then the likely direction of 10-year yield over a period of time will be more like 5.5 or 6. So equity market today is pricing that RBI will eventually win this battle of inflation. Like in the Western world, US Fed during Paul Walker time raised interest rates but killed the demon of inflation for next 20 years. Similar thing will happen in India, and hence equity market today is taking a longer term call on interest rates, assuming that RBI will win the battle of inflation and lower the 10-year yields to 5.5 or 6 level, whereas the bond market today is paying the short-term pain, is paying the price of short-term pain in terms of demand-supply mismatch. So we have slight amount of distortion between bond market and equity market, and if equity market starts becoming nervous about bond market, then certainly there will be correction.
So Nilesh, you are completely not in tandem with Uday Kotak's latest tweet, right? Because that's something that we woke up to the new year with, saying that the G-Sec 10-year yield is up 100 bips year on year. Watch out for oil, watch out for US interest rates, investment flows, hide current account weakness, strong rupees hurting trade. And in fact, he's saying that, when savers move money from debt to equity, since debt is risky in rising interest rates, we are in a bubble territory. Savers, he's saying, need to be on the watch and need to be on alert.
Definitely, we are in complete agreement. In fact, we also released our market outlook for 2018, where we have told investors that if you are bringing in money from bank fixed deposits straight into balance fund, looking at the dividend track record, that's not appropriate thing. You need to transit via monthly income plan or equity savings schemes kind of hybrid funds, and then move into balance fund, and then move into large cap equity fund. To all our investors, we have been talking for almost last 3 months that if you are over leveraged into equity, this is the time to book profit. And on ET Now itself, on this platform itself, I have said this over last 3 months that if you are over leveraged, this is the time to take your profit out of equity market. This is not the market where you remain over leveraged or over allocated. To new investors who are coming in, we are again requesting them to come by a systematic investment plan or systematic transfer plan. We are also telling them to have a long-term horizon. While we are bullish on the longer-term outlook of the equity market, there is no denial to the fact that oil prices have moved up. It's going to impact our inflation. It's going to impact our current account deficit. It will have an impact on currency at some point of time. Interest rates have moved up in anticipation of inflation rising. And while equity market today is assuming it to be a transient, it could become little more medium term in nature if inflation continues to rise. The fiscal slippage has happened, fiscal deficit is on the high. And in the fourth quarter calendar year 2018, market will start discounting the general election uncertainties. So overall, we do believe 2017 was a great year from a return point of view.
We've seen a new US tax reform, corporate taxes being slashed down considerably. That's boosted bonuses to employees. That's expected to boost profits. It's likely to trickle down to the consumption side of the economy. We've had a great consumption year. But do you think that, that's going to be the trend where, the fiscal support is not only going to be about increasing spending, but it's also going to be about tweaking taxes, especially, at the cost of maybe the tax to GDP revenue coming lower, to spur consumption and to get the investment cycle going? And that would, in a meaningful manner, compensate for, the lag that we're seeing in earnings thus far.
So there is a proverb in Gujarati about something like this: Lamba sathe tuko jai, mare nahi to mando thai. If a short man starts walking with a tall man, then either he will injure himself or he will fall ill. US is a tall man, we are a short man. US is a $15 trillion King Kong, we are monkey compared to them. So we should not copy what US is doing, because they have, reserve currency of the world. They can get away with murder, we can't get away with murder. They are the largest debtor to the world, and yet they enjoy much higher rating than many other countries. So let's not copy what US is doing, we have to copy what is appropriate for us. Today, the fact remains that the monthly GST collections are way below budget estimates. Now, hopefully businesses will settle and GST collection will improve, but till such time that happens, the fiscal constraint on budget is very, very high. the finance minister will have to be very innovative in raising revenue. He'll have to plug the loopholes, he'll have to collect revenues in order to compensate for the drop in GST collections rather than give more tax incentives. Couple of things which finance minister should consider. There is this concept of bonus stripping and dividend stripping. In no part of the world bonus shares are valued at zero. It is always arrived based on the original cost of acquisition. If you plug the loophole of bonus stripping and dividend stripping, easily government can collect between 15 to 20,000 crore. Similarly, if we see today, non-cigarette tobacco products are getting taxed at a much lower level than the cigarette-based tobacco products. The range, which about a decade back was around 20 to 25 times, has now moved to between 55 to 60 times. What has this resulted into? This has resulted into smuggling of illicit cigarettes in India, and government is losing revenue on it. Yesterday, Times of India had an article about how a person was caught with illegal illicit cigarettes. Now, if you can rationalize non-cigarette tobacco products and tobacco-based cigarette products taxation, then probably you can get another 10,000 crore in terms of tax collection. So there are easy ways to raise revenue, like introducing long-term capital gain tax, which will have disastrous consequences. There are innovative ways of collecting taxes, like plugging loopholes on bonus stripping, dividend stripping, rationalizing taxation structure on cigarette-based tobacco products and non-cigarette tobacco products. If you can raise revenue through this innovative means, then you will be able to maintain your fiscal prudence path that will reassure investors, and yet it will give revenue for spending money on rural agriculture and infrastructure theme, which is necessary from election point of view. So finance minister will have to muster all his innovation by listening to the market, by doing his own research and raising revenue in a non-disruptive way.
No, and that's a very critical point that you've raised, because there is buzz in the market about corporate taxes coming off, and largely the model of revenue generation being followed, or rather largely the model of corporate taxes being cut, being followed world over. So that's an important angle and an important point that you're making. I just want to then ask you, how can this budget balance off the expectations on managing the fiscal deficit, because that's going to be a key signal that the government would be sending out. We are assuming that for this year it's going to be 3.2 to 3.7, given the new borrowing announcement. But for next year as well, most of the market believes that they can't go ahead with a aggressive consolidation plan, given that it's going to be election season soon enough, state elections and then the general election. So what can the government do aside of coming out with innovative revenue generation ideas to really signal to the market that, look, this growth will come at a cost and we may have to bear it for some time, which may also not derail market sentiment?
No, I don't think so. We should deviate from the path of fiscal prudence. Between 2003 to 2008, Indian equity market got re-rated simply because fiscal consolidation happened. In 2008, due to global crisis, when we gave up fiscal consolidation, that resulted into eventual derating of India. Today, 2014 onwards, when we have given the roadmap of bringing fiscal deficit from 4.5 to 3% level, it has resulted into re-rating of India. We have now received lots of FDIs, lots of FII, and God forbid if $30–40 billion of foreign portfolio investment in debt market wants to withdraw because we are not honoring the path of fiscal prudence, I think we won't be in a position to manage that efficiently. Our rating has been upgraded on the assurance that we are going to honor the path of fiscal prudence. So there's a lot of things at stake to maintain the path of fiscal prudence. Yes, 3.2 can become 3.5, but eventually we should be moving in direction towards 3%. The second thing, Indian government might be liquidity poor, but it's quite asset rich. You have so many of assets lying all over the country which you can monetize to fund your fiscal deficit. For example, another example is Custodian of Enemy Property Act. It's sitting on 1,25,000 crore of assets. 25,000 crore is in equity shares and other instruments, maybe about 1 lakh crore is in real estate. Why can't we monetize that? What are we keeping that for? If it's not going to come handy in today's scenario, when will it come handy? So there are 10,000 ways in which government can raise revenue without disrupting market, without disrupting economy. There are 10,000 ways in which government can monetize its assets and fund the fiscal deficit and yet maintain the path of fiscal prudence. This is an hour where you need to be innovative, you need to be listening to the market, you need to be raising revenue without disrupting economy, rather than just taking the easy way out, saying that we are in a tough situation and we are ignoring the path of fiscal prudence.
Nilesh, so what to your mind should be a realistic return expectations from equities in next 3 years? Double digit or late single digit?
My guess is that, Nikunj, just to be on the safer side, it will be somewhere around 3 to 4% above inflation rate. And if inflation is in mid single digit, then maybe we'll just cross into lower double digit. But if RBI is able to achieve inflation at the target given to it, then it will be in lower single digit. My guess is that we are slowly transiting into an era where returns will start getting moderated, somewhere between higher single digit to lower double digit. An interesting challenge from a fund manager point of view will be, no longer we will be able to add value to customer by offering plain vanilla products, a diversified large cap, mid cap or small cap. Eventually we'll have to acquire the skills of long short, leverage, concentrated, as well as offshore investment in order to add value to the customers. If we are able to acquire those skills and manage those kind of products, we will still be able to deliver lower double digit returns, even when plain vanilla products will deliver higher single digit returns.
Interviewed Ray Dalio about 2 weeks ago, and the sense which we got from the man who runs world's biggest hedge fund is that 2017 was a year of transition. Interest rates and risk premiums are at a all-time low, and they can only go one way, which is go higher from here, which will have an impact on cash flows and which will have an impact on US earnings. He's making a case that US markets will come down and buyers of emerging markets beware. So are we completely rubbishing and not acknowledging the importance what global markets could play in 2018? As of now, there is an air of optimism. If after such a good 2017, if I hand a microphone to someone who's giving a bearish opinion, that's not a very good experience. But do you think somewhere we run the risk of some global blowout in 2018?
So today morning I got a chart comparing 2-year Greece bond yield vis-a-vis 2-year US Treasury yield. At the beginning of the year, the gap was very, very wide, probably 10% plus. At the end of the year, US 2-year is yielding more than Greece 2-year. If I had predicted that Greece will start giving lower return than US Treasury on 2-year basis at the beginning of 2017, everyone would have said that I have become mad. But at the end of the day, I would have been proven correct. Maybe Ray Dalio, being such a great name, is indicating what's going to happen. However, I just want to counter Ray Dalio by saying that in Japan, interest rates have remained near zero level for decades. And there were many Ray Dalios questioning, when will Japanese interest rates move? They questioned it in 95, they questioned it in 2000, they questioned it in 2005, they questioned it in 2010, they questioned it in 2015, and we are in 2018, and yet the same people are questioning, one day Japanese interest rates will move from 0% level. Lower interest rates are like steroids in body. Once you give, it is very difficult to take it out despite having side effects. I'm not saying that Ray Dalio is wrong. All I'm saying is that there is a counter-intuitive, counter-balancing mechanism in Japan where we have seen for 25 years interest rates have remained lower and almost hugging 0% level. And in the foreseeable future, it is not visible if Japanese interest rates will go up. In fact, if US Fed is going to follow Japanese central bank model, then eventually to stop the market or to support the market, they'll have to start buying equity. Today, Japanese central bank owns equity in majority of Japanese corporations and significant minority stake. So we don't know where the world will go, but is it time to be cautious listening to people like Ray Dalio and Uday Kotak? Answer is definitely yes.